On All About Stocks this week, the market's correct by 3% on profit booking. Will tell you what your strategy should be. With the rupee hitting a 3-month low against the dollar, we'll tell you what stocks to watch out for. And while we keep getting excited about the GDP numbers, core sector growth and inflation, what sort of an impact will all of that have on your portfolio? We'll find out on the show. Welcome to All About Stocks. You're watching ET Now. I'm Fee D'Souza. This is a show for retail investors who like to invest their money in stocks. What we're going to do right now is tell you how the market did during the week while you were busy at work. We'll tell you what stocks you should be adding to your portfolio. And we'll also answer the questions you sent in during the week. Remember, our email ID is at the bottom of your screen. You can also reach me on Twitter. It'll be my pleasure to hear from you. First, let me bring in my colleague Ajay, who's going to give us an update on everything that happened at the last street this week. Ajay.
Faye, it was an extremely challenging week for Indian equities, this one, and really saw it coming because there were the large cap stocks which started cracking at the start of the week. Net, we've lost about 3% on the benchmark indices. In fact, interestingly, it's the broader market which are relatively resilient. The small cap and the mid cap indices have fallen much lesser than the large caps. Couple of triggers. Several days we saw big amounts of redemption coming in from the FI side. On one instance, so over 1,500 crore was sold off. So some profit taking by FIIs. Global cues were not particularly supportive. That also weighed on Indian equities. And then the last leg of the first quarter earnings started disappointing, with several of them like HCL Tech, Tech Mahindra, to name a few, started really rubbing on to the market and sentiment. And net we have lost out. Also, a point to remember is that for the three past series, we have seen massive gains coming in. So probably the start of the August series, we are witnessing some profit taking. Going forward, traders on the street believe that it will be the RBI policy and global cues which will really give more direction to the market. But after a spectacular rally for several weeks, one should be heading in for some range-bound kind of moves and very stock-specific action in the near term.
All right, Ajay, thank you for that update. Joining us today, Prakash Sivan, Director at Altamount Capital Management. Prakash, thank you so much for joining us. I know there's a lot going on, going by what Ajay just told us. I want to simplify a lot of things. One of the biggest moves that happened, although the market rather ignored it, were the core sector growth numbers that came out. And I remember in any news channel, we get very excited about these things. I'll tell you what happened. Coal, cement, steel, electricity all grew much more than expected. Everybody thought it's going to make a really big difference, and on Friday the market's going to look really good, but that's not what happened. The market took quite a beating. There was a lot of profit booking. We reacted more to global cues than we did to what was happening in our own country. So I want you to help us understand this. When we talk about big economic data, whether it's the GDP, whether it's inflation, whether it's core growth, IIP, all of these things, as a retail investor who has 12-15 stocks in my portfolio, does it matter to me? Should I bother to track it? Should I worry about it?
Well, the answer is yes, it's fancied a lot by people who use information to make a profession out of it. So naturally all of us love that. But to somebody who is a long-term investor, it does not, except when you have some leading indicators that get announced.
So what is a leading indicator?
Yeah, so leading indicator is something that happens before a larger event takes place. I'll give you an example. There's something called housing startups, which housing starts, which is not something that we have a very organized way of doing in India as yet. But in the US, it's a very common data. That actually tells you the number of houses which have sought permission to start construction.
Give me an Indian example of something that's leading data.
Within India, you would probably find the credit policy and the dialogue that happens subsequently is always a leading indicator of what the RBI expects things to be, particularly in correlation with inflation, correlation with the macro numbers like the deficit and the way the government is going to tackle that. So it talks about the expectation of money supply, inflation, things which are futuristic. So it becomes a leading indicator of sorts. But the data that you mentioned that came out recently, which talked that things have done well, is post facto. It's already
time
happened. That's gone by. So that's a lagging indicator. So lagging indicators usually tend to help you validate a decision. So if you are in the sector which has done well, you stay put. But if you feel the sector that you are in hasn't been reported with very good numbers, you probably need to question the stock or the sector itself. But these data points should not be taken in isolation. They always to be used as an inference-based point, but not the decision itself.
Well, obviously, one of the things that a lot of people are going to be asking you right now is what your expectation is from the RBI on Tuesday. But I want to understand this. If I'm watching this show at this point with a few bank stocks in my portfolio or NBFC stocks in my portfolio, and I see rates being changed, how much should that worry me if I'm a long-term investor?
Interest rate movements, even if they were to be announced by the RBI, are not huge in quantums which could make a significant difference. We've always seen a tweaking of 25 basis points, which is 1/4 of a percentage. And that really doesn't alter things dramatically for an investor to kind of lose heart or to suddenly hit a jackpot. What it does is it indicates, as I said earlier, the direction in which things are going to move. Okay, so RBI will always do what is called calibrated moves, gradual calibrated moves. And these are not knee-jerk reactions, they're well thought of. So they tend to explain what policy makers expect the economy to shape up with. And you need to align yourself with that, but not really get disheartened or be overjoyed with just one announcement.
All right. Other interesting indicators that have come out, and that's the earnings season. Yeah. We saw ICICI Bank nicely surprise the street. There was a pleasant surprise there. Maruti numbers came out, JSW Steel. Again, if I'm looking at my portfolio and I read about the numbers, how much should I base my decision on that stock, on the numbers quarter to quarter?
Okay, very valid. Why do all of us look at numbers so actively and keenly? Numbers are again more of a validation tool for you. You have invested into this stock. You want to make sure that nothing's going against what you expect the stock to behave with or to do. Let me put it like this. You bought into Maruti. Maruti comes up with numbers which are very decent. In case there's something which is not in sync with what your expectation were during the last quarter, you need to take course correction. And remember, more than just the numbers, it also explains the management guidance, the management commentary is much more critical in terms of your decision to hold on to the stock, to add to the stock or to reduce the stock. So all ratings on the stock or price targets get revised dependent on that and not necessarily what's already happened. You can't really undo what's already happened. And remember, today we are talking in the second week of, or the last week of July or the first week of August on numbers which are as on 30th June. So it's anyways dated.
All right. What should we be doing right now given the fact that the rupee has slumped to a 3-month low?
I think this is more in sync with the global cues. You could probably see a risk off, as it is called, you know, the mood is to take away money back to the US dollar. And if that were to happen, you could also see 62, 62.5 on the rupee. So, you know, I don't think there's anything alarming about it, but the rupee has been very solid at the sub-60 levels. And the RBI has done enough to build a war chest, at least start building a war chest in terms of our reserves. So I don't think we are in such a precarious situation. And, you know, the best thing that's happened in the last 18 months odd is we started off in January, this deregulation of diesel prices. And you'll be surprised that we are, you know, within sniffing distance of making it nil. Which means every production, every liter of production on diesel from the refineries today will be sold at whatever cost they have. And there is going to be no subsidy in that. So right now it's about 1.33, maybe another 2-3 months and that will go away. And that's a remarkable shift. So you're not really going to be worried about the dollar and the rupee so much ever after once that gets maintained.
The other thing I want to ask you about is the correction that we saw on Friday.
Yeah.
Now, for a while, we've had viewers write into us who've said that, okay, the market has really run up. Should I get in at this point? Should I get in at that point? The fact that we actually saw that cut on Friday, especially in those large blue chip stocks, is that an opportunity for us to get in? Now, Monday morning, if we manage to still get maybe similar valuations on some of those stocks, should we consider buying?
Yeah.
RIL, for example.
Yeah, absolutely. I mean, I really wonder why people, you know, keep on wanting to buy into stocks and the same stock at 20% less doesn't seem attractive or stop seeming attractive. I think it's more to do with, you know, people getting carried away with the overall mood. But remember one thing, it's only stocks which are overvalued that have corrected. I mean, you still have on Friday stocks like Levers and ITC and Reliance that have not corrected so majorly. So, you know, there's always a level that stocks will come down to, and that's exactly what value picking is all about. So be patient, don't lose heart if the stock is run up. You'll get a chance someday to buy it at some decent value. But when that value happens, when that day comes, don't hesitate.
All right, between RIL HDFC and ITC, all of which saw some marginal cuts on Friday. Which one would you buy on Monday morning?
Reliance, absolutely.
Reliance, all right, okay. Let's take a few questions. Raghavendra has written in, he has 10 shares of ICICI Bank, bought at 11.93, and 10 shares of Tech Mahindra, which he bought at 18.65. He wants to know if we should hold on to both of those stocks. ICICI Bank's numbers were in line with expectations, although their asset quality remains stable. What would you recommend we do with ICICI Bank?
No, I think the numbers don't indicate any sort of an alarm. The 17% growth in profits that they've reported on a scale like this is impressive enough. And I think ICICI would probably be one of the key players in this entire re-rating for banking, that as and when it happens, it could take 6 months, it could take another 9 months. People expect things to happen very quickly, and that's the sad part. I mean, we've had a great budget, but the impact is going to be felt only 12 months down the line. So for those 12 months, you need to figure out what to do with yourself. You know, you can't really have miracles happening every quarter. And ICICI, Axis, Kotak, HDFC, all of them have been delivering consistently. So really, I don't know why people get so worried with just one quarter earnings and something going wrong.
A good example of that would be Tech Mahindra.
Well, Tech Mahindra has had some issues. The reason why Tech Mahindra is now struggling at a larger scale is, remember, they grew as a very small company and they grew a bit too fast. It's one of my favorite IT picks also. But today they are at a stage where they're finding it extremely difficult in terms of quality delivery as compared to a TCS or maybe even an Infosys or an HCL Tech could manage. So they'll have to invest into themselves in processes again, and that might take some sort of a pause.
How long should he hold on to this stock for?
No, I think Tech Mahindra he could probably book out. It's really not something which might grow as fast as a TCS or probably even an Infosys would. I'm quite bullish on Infosys with the new change that's come in. And if things were to really go the way we all expect, Infosys could probably come back into its fold maybe in the next 12 to 18 months.
All right. Let's take another question. Mahavir Jain has written in. Now, he has 50 shares of SAIL, which he bought at 102 rupees. He wants to know if we should hold on to that stock. Now, SAIL ended the week at 86. Remember, we talked about the fact that core sector growth, we saw the steel sector do really well. Yeah. Should we read into any of that? What's your reading of this stock in particular in comparison to the rest of its peers?
Yeah, well, this has always had a PSU, discount of sorts. Look at what Tata Steel has done in the same period, and you'll be surprised, pleasantly so. But SAIL hasn't been able to do the same kind of act. But I think very clearly the government is keen on making these large behemoths profitable because it has a cascade effect. And given the fact that China is finally kind of rumbling back to some sort of a positive activity mode, all steel companies would do well, including SAIL. So I don't see any despair in this particular thing just because it's at about 20% less or whatever. He could still recover his money very comfortably.
How long do you think he's going to have to hold it for, though?
Maybe another 6 to 9 months.
All right. So if you can hold it for 6 to 9 months, it does make sense to hold on to it. Now, I want to take a look at Prakash's report card. Now, the last time Prakash was in the studio, he recommended Heidelberg Cement India. This was on the 9th of May this year, when the stock was trading at 46 rupees and 35 paise with a target of 60 rupees for 1 year. That stock is currently at 63. It's crossed its target in just 2 months. Well, thank you for that strong recommendation. But for those of us who bought it with a 60 rupee target, what should we do now? Do you want to revise that target?
I think, I mean, the cement play has been very surprising for all of us. Honestly, it's of course the combination of a new government, the budget, and this whole euphoria. But cement companies do not deserve the kind of valuation they're right now at. So I would book profits definitely, because I would have probably discounted much more growth. Of course, Heidelberg has reported some very good numbers also. Their Q2, they follow a calendar financial year, and the second quarter numbers have also been quite impressive. It's a debt-free company almost. But I would recommend booking profits at this stage.
All right, book profits in that particular stock, and we'll take a very quick break. When we come back, we'll review Prakash's own portfolio. We'll talk about stocks like Kane India and M&M. Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. Prakash Diwan is still with us, and we're figuring out a long-term strategy for your stocks. Now, it's time for us to take a look at Prakash's own portfolio. Now, remember, Prakash designed a portfolio for us on this show on the 30th of November 2012. We've been tracking this portfolio every time he comes into the studio. It's at an overall gain of 23.67%. Compare that to the Nifty over the same period, that's up 29%. The portfolio is underperforming the Nifty by 6%. But remember, on Friday, we saw a large cut in the market, so it's also going to reflect that market movement. I'm going to give you a quick recap of the stocks in Prakash's portfolio. There's Gujarat Pipavav, that's up 100% since we bought it. Tech Mahindra, it's up nearly 60%. Kane, Cipla, Coal India, ITC, M&M, and Tata Steel. Prakash, if we take a look at your portfolio, and this is something that's been hurting for a really long time. There's Coal India, and now Kane is down 5%. Do you want to make some changes there?
I think so, and not because of the underperformance alone. But I believe the recent announcement from Keynes, as part of the quarterly earning and the disclosure, very clearly show certain issues which could get, the corporate governance to be questioned. I mean, they have lent to a group company at sub-market rates, and, significant quantity of the cash has been deployed there. I mean, if a company has surplus cash, they should give it back to the shareholders. They should have paid out dividends, whatever. So that's not happened, and that's exactly why the stock probably is not going to do too well even going forward. So while sticking to the same hydrocarbon sector, I would probably go into Reliance. Though Reliance was also at elevated levels compared to what it was when we started the portfolio. But I believe Reliance still has a significant upside in terms of certain triggers related to the gas pricing.
All right. What would be your target for Reliance if we get in at the value that it is right now?
I would be patient enough to see Reliance at probably 1,500 plus kind of levels for the next year and a half, 2 years.
And if you're looking at the next 4 or 5 years?
Oh, then you probably have so many other businesses adding to it, so it could probably double within the next 4 years.
All right, I'm going to ask you about Coal India. It's down 1% still, and we've been talking about it for a while now.
Yeah.
Tell me why you still have so much faith in this stock.
It represents a business which is so unique. I mean, the only guys who have access to coal in such a large geography, coal is something you can't do without. I mean, it's just a question of it's a question of actually making the business profitable. That's
yes, Prakash, but it is being managed by the government.
That has to change.
That has to
Either
change,
the
but how
government
long
has
are we
to
going
change
to
its way of managing it, or the ownership has to change. And I have a feeling this government very clearly needs to do that, because there's a lot of things dependent on coal supply to the power sector, to getting it down to the downstream user. And I mean, you have so much dependent on this. You cannot ignore Coal India for too long. I mean, it's at your own peril that you would do as a government. And it's a huge thing to take on. There's a lot of union issues, a lot of mafia issues, so it's not so simple, and that's why it's taken so long.
This is my reservation when it comes to stocks like Coal India. While fundamentally on paper it makes a lot of sense. You're talking about something that supplies to power companies. Yeah. Power being what it is in terms of the political arena of this country, being such a sensitive issue. It's not like a power company is going to manage to hike its prices based on demand and supply.
Right.
Similarly, Coal India is something that's being controlled very carefully by the government. Even if, like you said, the ownership of the management were to change, it would still be something that the government would focus on.
I agree.
Where do you see that actual change in, efficiency coming in, and how long?
Let me throw back the spotlight on a few decades. When we were kids, I remember, buying a new car was always like at a premium, because there were very few manufacturers. Getting a phone connection was like a luxury. You used to have one in the entire building, and everybody had to use that, somebody else's home, and you use the telephone line. Today, not only is it accessible, but the costs have come down. So every time the government stops intervention in the wrong way, things improve. And mind you, the rewards of something which is so large and so complex, once it gets unshackled, will be disproportionate. So Coal India could be 3 times from where it is in a year's time, if really things happen. So I wouldn't mind sitting on it. So there are certain stocks which would probably behave in a binary fashion. They might be stagnant for a few years, but when they unlock, they really give you that, and they actually catch up with the lost time.
All right, I have a very quick question for you. Now, most of the other portfolios designed on this show have about 15 or 16 stocks. You have only 7. Also, interestingly, you have no banking exposure in this portfolio right now, no NBFC exposure. Also, the bigger stocks that may hold interest in mutual funds and insurance companies that might be listed in the future. Do you feel no need to invest or bring in any of those stocks?
No, I started off with this idea that this was for a beginner, and I would still believe this portfolio is something that you can still go to sleep with without any issues. They could be underperforming in the short run, but as we mature into the holding period, and we moved out of banking some time back. So right now I'm not too bullish on banking, but if banking starts looking promising, we could definitely add that.
Let me give you a recap on the stocks in Prakash's portfolio. Gujarat Power Port, Tata Steel, Tech Mahindra, RIL, Cipla, Coal India, ITC and M&M. Let's take a few more questions that came in during the week. Raja Lakshmi has written in. Now, she tells us she holds 200 shares of HCC, which she bought at 36 rupees, and 200 shares of Federal Bank, which she bought at 120 rupees. She wants to know which of these stocks she should hold on to. What's your call on these stocks?
Well, yeah, I mean, both these stocks don't happen to be very popular at this point in time. They're high beta definitely, but given the kind of momentum that we've seen, and HCC also is talking about an IPO possibly, which could be a huge unlocking of value, I think it's worth the wait.
All right, let's take another question. Karan has written in. He has 200 shares of Dish TV, which he bought at 61 rupees, and 1,000 shares of SKS Microfinance, which he bought in 280 rupees. He wants to know which one of the two he should hold on to. You're pretty bullish on SKS Microfinance right now.
Yes.
Would you recommend he holds on to that stock?
Well, I love this stock, and again, if you see the earnings, quality of earnings that we've recently seen, that just goes to reinforce the fact that here's a company that's on a rebound of sorts. It's lost its glory days from those 1500 kind of levels, but for different reasons. I'm not saying it's going to hit back 1500, but I wouldn't be surprised if this is a stock that gets coveted in most institutional portfolios very soon, and it'll start fetching a much higher premium. Dish TV also is significantly good. I hold a position in both these stocks personally, but Dish TV is something that has really surprised people by not moving all this while. But the real benefits of digitization on this entire television network is yet to kind of happen, because it's finally moved to tier 2 and tier 3 towns. It's not, which wasn't the case earlier. And Dish TV has huge benefit from the Z stable on content costs. I mean, they virtually have content which comes free for them, which you don't have with a Videocon or in Bharti Airtel or a Reliance this thing. So I think you would continue holding both of these.
All right, hold on to both of those stocks. It's time now to take a look at our portfolio of the week. Now, every week, we take a look at the portfolio of one lucky viewer and tell you, after looking at all of your stocks, which ones you should hold on to and which ones you should sell. This week, our lucky viewer is Ajnesh. Now, Ajnesh has sent us a list of the stocks he's holding. 2,000 shares of LIC Housing Finance, bought at 325 rupees. What's your call on LIC Housing Finance?
A good company, but it's quite high beta, moves up and down, gives you a lot of discomfort actually, the way it kind of gets punted on. But he's not gone in at very ridiculously high levels, so I think it's okay. He could probably still buy this time. He's got a significant quantity of shares, so that's the only cause of concern. But otherwise, it's a good pedigreed stock.
300 shares of L&T bought at 1650. That stock ended the week at 1468. Now, after all the tom-tomming we had about the infrastructure sector that's going to run away, L&T leading that pack, how long is he going to have to wait to recover those levels of 1650?
I don't see L&T coming back to these stratospheric levels again so easily. I mean, this was sheer euphoria. Company is really struggling to grow in the domestic market, and till that traction happens, I'm not too sure whether it's going to be higher than what he's bought in at.
Well, he seems to have picked up a lot of his shares at very high levels. He also has 300 shares of J&K Bank, which he bought at 1550. Stock ended the week at 1600. Should he be holding on to J&K Bank?
Yeah, I don't see any reason why he should be disappointed here, except that he needs to make sure that if it starts slipping too rapidly, he needs to at least book out the loss and stop his loss at some level. But in the long run, I don't see an issue with the bank.
All right, 4,000 shares of GP Associates at 69 rupees. Should he hold on?
Well, this is a group or a stock that's always been in the news for a lot of, deleveraging opportunities and stuff like that. So it's going to be trigger based. You need to be patient with it. But if he's patient enough, he could probably see those 85, 88 kind of levels also in this stock.
Well, 650 shares of Lorry at 500 rupees. That stock ended the week at 548. Fundamentally, it's a great company. Stock is not showing that kind of return yet, though. How long is he going to have to hold on to it?
Yeah, so, again, the company's got great pedigree, great business model, but doesn't really reward its shareholders, hasn't rewarded its shareholders. So, but, these stocks are difficult to lay your hands on once you've let them go at higher levels, if you thought you could re-enter at lower levels. So, unless the investor is agile and nimble enough, otherwise you could probably book out of this and, he's got no banking exposure. So, that's something which I believe in a large portfolio like this in terms of amounts, he should have certain exposure to banking as well.
All right. Unfortunately, that brings us to the end of the show. We've completely run out of time. Remember, if you have a question, you can email us or you can reach me on Twitter. Prakash, thank you so much for spending time with us this weekend and answering all of those questions. Keep sending in your stock questions. You can also reach us on our Facebook page. Thanks for watching.